Now that you know what a mortgage is, let's look at how the interest rates play a part of this. Think about in a 25 period how much the world has changed. There are recessions, there are boom periods, changing presidents and laws. The point is, it can be very hard to predict what the economy will look like in even 7 years. For this reason, when you get a mortgage, your interest rate will be locked in for a certain period of time. Once that time is up, you will have to shop around and negotiate another rate to lock in again. This protects you and the banks. For example, take a look at the COVID-19 pandemic. Interest rates are around 1.5%. If you are locked in for 5 years, in 5 years from now the economy will have recovered. When you look around for another rate, it might be 3%. If they locked you in for 1.5 for 10 years, the mortgage lender would have lost out on all that money when the rates went up. But the same can be in reverse. Say you got a mortgage when the interest rates were high. Now you are re-locking it at 1.5%. You'd be locking it at a much lower rate, so you'd be saving money. There are two types of rates you can get: fixed rates or variable rates. Fixed rates are the same throughout the entire lock-in time. The rate is determined about how the economy is doing. Variable rates are a little bit different. They're based on the prime rate, which is the rate that the Bank of Canada loans out money to other banks, such as RBC and TD and so on. The variable rate is said to be prime plus or minus X. For example, if the Bank of Canada says prime is 2%, that means if RBC wants to borrow money from the Bank of Canada, they would pay 2% interest. The variable rate they're offering you is prime plus a half. Your interest rate would be the prime rate, which is 2, plus 0.5%, 2.5%. If the prime rate changes, then your interest rate will change. So if the prime rate changes to 1.5%, your interest rate is prime plus a half. It goes down from 2.5% to 2%. You can save a lot of money going variable if you get lucky with the interest rates and you believe it's going to be lower than the fixed rates for a while. But if the prime rate goes up, then your mortgage interest rate will go up. It is recommended for first-time buyers to stick with a fixed rate so that you have cost certainty in how much you're going to be paying each month.